That's the first time that's happened. So big topic, 30 minutes. I've tried to break it down to what I think will be the most useful areas. And really, these are the three questions that we get asked the most by people. So that's what I'm going to try and answer. So we've got who actually pays for a stay in a care home, because unless you've dealt with this before, it can all be very confusing. It might not be relevant to everybody this morning in terms of whether there's a property involved, but it often is the case. So I think it's important that we do look at this as to whether or not a property does have to be sold. There's sometimes an assumption. I spoke to a lady just yesterday who was talking about handing the keys to the council on the property, and I just thought, hold on, let's take a couple of steps back and look at the rules around this. And then in closing, we're going to look at whether there's an option in the absence of the government having fixed our social care crisis yet. It's been talked about for years and years with lots of proposals put forward, but nothing has changed yet. Is there a way for an individual to cap their own care costs? Because we know that's a source of great concern. So that's the sort of three main areas that I want to cover and try and answer. If that doesn't meet your agenda, it doesn't cover all the things you wanted to know, then as Susie said, just we can get in touch afterwards and have a chat one-to-one. So before I try and answer those questions, I just want to give you a bit more of a formal introduction, just to be polite really. So we are a firm of SOLA accredited independent financial advisors, SOLA being the sort of base level really for finding somebody to talk about later life matters. It's sort of deemed the industry gold standard. All my team are SOLA accredited. Where we're different to most financial advisors is that we specialise exclusively in solutions for care fees funding. So if you've got questions about mortgages or life cover, retirement planning, that's not us. We are qualified in those areas, but we don't practice in those areas. Our niche, our area of expertise, because it's all we do every day, is talk to families about funding care. And the reason we do what we do and why we specialise, I actually set the business up. It's my company, set up in 2007 because we as a family were sat where some of you might be sitting. And when my grandparents went into care, we got absolutely no advice. Now, it's not anybody's fault per se. We didn't know there was advice that might benefit us, so we didn't go looking for it. And the professionals kind of involved in the journey probably just assumed that we had it all sorted, or that we would know who to go and talk to, which we didn't. So the reason for the company really is just to make sure that people can make informed choices and weren't making the sort of errors that we were through lack of knowledge. So whilst we're here at the very kind invitation of Susie today, we don't have a commercial link with any care provider. We work with many, but it's just about getting the right information to the people that need it. There's no untoward link there. And if we're talking about money, you would expect and hope we are directly regulated by the Financial Conduct Authority. So if you look us up on the FCA register, there we are. And although I'm talking to you from, it was sunny, it's gone a bit cloudy, Bishop Stortford in Hertfordshire, we deliver our advice even pre-lockdown. Most of our advice was delivered by phone, email and post. Now much more latterly, obviously Zoom as well. And the reason for doing that was predominantly because families involved in these sorts of decisions aren't all in one location. And what we didn't want was things to get lost in translation, where I might meet with one family member who then has to tell the other family members what we talked about. If we do it all at the same time together on a phone conference call or by email, everything is clear, nothing gets lost in translation. It just seems to make more sense. So this sort of notion that you have to have somebody come around and chat to you, I think we can do things a bit more efficiently these days. And in closing on the introduction, really just to make the point that we're not a charity, we are a commercial organisation. But I can honestly say to you, around 90% of the calls that we take or emails that we deal with, 90% of the work we do is pro bono. So we are not a company that charges hourly rates or fixed fees for having a chat. We don't know if we can help you until we've spoken to you. You don't know if we can help you until we've had a chat. and there's an awful lot of information and knowledge that we have that we are happy to share with you. If there is a specific financial product that you end up wanting us to research for you, we'll again do the research free of charge. If you buy, we get paid for arranging that contract. But up until that point, you have complete access to our expertise and experience free of charge. I imagine a few businesses would do it differently, might disagree with that. It's what we feel comfortable doing, and we can afford to do it because of the volume of calls that we take. So back to the agenda. Nothing I'm going to say today is particularly good news. I don't particularly agree with the system, but I think it's important that we all know where we stand with it. I have to caveat what I'm about to say this morning with the obvious, which is that I'm simplifying it. So there's quite a bit more under the surface. And also that with the current pandemic, and there are certain discharge to assess processes in place that we didn't have before the pandemic. So there are certain people that might be getting temporary funding that ordinarily wouldn't be getting. I'm looking at how the system works when all of that flushes through, so how it should work in the long run. So in simple terms, 3 funding streams that we have. You're funded by the local authority, social services, the council, it's all one and the same place. You are potentially funded by the National Health Service, who we all know and love, or you are a self-funder. That's sometimes also referred to as a private fee payer, for example. So they're the 3 categories. There can be some interaction, but normally not. Taking them one by one, local authority funding. So the most important thing here, just as a point of note really, is that you have to meet the local authority's eligibility criteria first. So anyone can have a care needs assessment, anyone's entitled to have one legally, and that's where the local authority draw up a care plan, what care is needed, what setting that might best be in. This has to happen first before any conversations about the money. That's how it is supposed to play out. And if you don't meet the local authority's eligibility criteria, then even if you have no assets yourself, they're not going to pay for you. So you have to meet their eligibility criteria first. My aunt, for example, might be feeling quite lonely, recently widowed. She might feel she'd benefit from a care home environment, socially, safety, etc. But she is unlikely to meet her local authority's eligibility criteria. So if she's got no assets, then even if she wants to go into care, it's not going to happen because the local authority won't agree to pay for her. So that's an important point just to be aware of. Only when the care needs assessment has been done should any conversations or assessments of the money take place. I know in practice it doesn't always work that way, but that is how it is supposed to be. And what the financial assessment is looking at, in crude, simple terms, is whether you have above or below a certain amount of money. I'm sure you are familiar with this figure. In England, it's 23,250, and that hasn't changed in 9 years. So it's actually going down in value. In Wales, it's a much more generous £50,000. People think Scotland is free. No, Scotland just have a little bit of a higher capital allowance, about 3,000 more than we do. And they do get some contribution towards care, but they don't get one of the state benefits that we do in England. So it actually comes out broadly in the wash as the same. But there we go. Local authority funding. So they're looking at that limit. Now, what counts as capital? If I were being flippant, I could say pretty much everything. And it is pretty much everything that counts towards the means test, as they call it. I'm going to mention 3 things that don't count. If you are married, when you're going into care, it's only your financial position that the local authority can look at. So the spouse that remains at home, 100% of any savings, investments owned by them don't count, can't be looked at, can't be taken into account, and only 50% of anything that you own jointly. So it does come a point in time as a couple, just for yourselves moving forward planning, there comes a point at which you perhaps ought to own things in sort of equal amounts, and maybe having a joint account is not always a sensible route at a particular point in time. Owning your halves separately might be a good idea. So it's just the person going into care, their capital. And the property, really important to note, if the property is left occupied by a spouse or relative over 60 when someone moves into care, that property cannot be taken into account either in the means test. It is not retrospective. We've had, this week, somebody advised actually by a qualified advisor, told that they would just come back for the money later. When the spouse at home moves out or dies, then their husband's care costs will be reclaimed from the house. It's like, no, no. The property is exempt if the spouse lives there. The relative over 60 rule, interestingly, I had a lady not long ago saying, so if I move, I'm 62, so if I move into mum's house when she moves into care, they can't include it. No, you have to have been a genuine cohabitee. It has to be your home for it to be disregarded rather than you just moving there. And just worth mentioning at this point, maybe around gifting property and transferring, etc., etc. People hear about a 7-year rule. That only applies to inheritance tax mitigation. It has no bearing on care fees planning. So the council can go back as far as they like to look at anything that they deem to be what they call deliberate deprivation. So if anyone has done anything that the council think was done to avoid the money being spent on care costs, they can treat the person as if they still own it. So again, just be aware of that. The last one I'm going to mention that is an exempt asset from the means test is an investment bond that includes life insurance. Actually, more people have these than you'd think. Anyone who's taken financial advice possibly would have one, and they wouldn't necessarily have gone and bought one themselves, but through advice they might have purchased one. If you're not sure what they are, the paperwork would refer to a life assured. It might refer to 101% payout on death, and the companies that offer this would be in the likes of Scottish Widows, Norwich Union, Aviva, people like that, rather than the Abbey National and Barclays. So if you're not sure, we can check for you. You can still use the money inside the bonds to pay for care, but you don't have to, and therefore it might affect any entitlement from the state. So get advice if you're concerned in any way about that. So that's what counts as capital. Everything else, the money in national savings, stocks, shares, ISAs, second properties, businesses, all of that gets taken into account, as does income. And this is often overlooked. So when the local authority agree funding, they look at somebody's income and take that into account. The state pension has to be put towards what the local authority agree to pay. A private pension would normally have to be put towards it unless there's a spouse. They can retain 50% of a private pension, okay? But the local authority agrees, here's the person's needs, this is what we'll agree to pay for those needs to be met. And let's say for ease of maths today that they agree to pay £500, but the individual has £200 of pension income, the local authority actually only end up paying £300. So it's your money and what they agree to pay combined. All right. Some people think, oh, I'll get the 500 from the council and then I can add my pension to that. No, that's not how it works. It's a combined contribution. But the local authorities are not supposed to just pick an arbitrary amount out of the air. They are supposed to find a care home place that will meet that person's needs and pay for that in full with no requirement for a top up, unless the individual or the family choose a different home, which they're perfectly at liberty to do. They could choose a much more expensive care home, get what they're entitled to from the state and top it up. So third party top ups if you make a different choice to the choice that was on offer from the council. Equally, if you are a self-funder to start with and you run out of money and qualify for state funding, the care home is perfectly at liberty, depending on the wording of their contract, of course, to ask for a third party top up in that instance. Okay, and it's for the local authority and the care home to sort of thrash it out. It's not a case of the local authority simply moving somebody. It doesn't quite work like that. So that's the local authority funding, the means tested, the social care funding system in a sort of whistle stop. If we now look at the NHS funding stream, this runs actually, in parallel, but very different to social care funding, because this system is not means tested. So it doesn't matter what your financial position is. With NHS funding, if you have complex healthcare needs, so we were talking with social care, that's around help washing and dressing, etc. If your needs are much more of a healthcare nature, the sorts of needs that might be met in hospital, you don't pay for that care in hospital. Why should you have to pay for it in a care home? That's the sort of rationale. But as I say, words like complex, unpredictable, unstable, they're the sorts of conditions that would qualify for NHS continuing healthcare, which you may have heard of. There's a very good website called Beacon, 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 that goes into much more detail about this. You can, even on the NHS website, actually access the tool, the checklist that they use when they do the initial assessments. You can see what sort of things people are looking for to likely qualify for this. So it might be something that somebody doesn't qualify for initially in their care journey, but if their needs become much more complex, unstable, unpredictable, of a healthcare nature, they could get it later on. If you don't qualify, someone doesn't qualify for it straight away but needs a little bit of nursing care, there is a level underneath this. It's called funded nursing care, where the NHS pay it just under £184 a week direct to the care home to help subsidise the costs. So be aware of this, nothing to do with your money, all about your healthcare. And we do work with lots of professionals that can support you in claiming or making appeals if you don't like the decisions. So just be mindful of it. But if you are not eligible for state funding, you have too much money, not eligible for NHS funding, not poorly enough, that's what means you're a self-funder. And the only positive I have, if you're not aware of it, is that as a self-funder, you can still claim or make a claim for attendance allowance. So this is a non-means tested state benefit, tax-free, not declared on a tax return, payable at one of two rates depending whether you need that help just during the day or during the day and the night. It's different to carer's allowance. This is paid to the individual that needs the attending to, and the trigger for the night rate is, I think, around 20 minutes of attendance or at least 3 accompanied visits to the bathroom, for example. So it's a horrible form. Certainly Age UK in a lot of areas offer an advocacy service to help complete these forms. Anyone in a care home is going to get this if they're self-funding. It's just at which level. But do bear with it. Again, we've got the link to the claim form on our website. The date that you ask for the form, that's the sort of date stamp. They then give you up to 6 weeks to fill out the forms and get back to them. And the person has to have been needing care for at least 6 months. So just bear that in mind as well. But definitely entitled to if you are self-funding. The only other help really for self-funders, unfortunately, is if they have a property and that property is the main asset. So again, apologies if this doesn't apply to you, but it does seem to apply to so many. It would be remiss of me not to include it. So if the property is being left vacant initially when somebody moves into care and their other funds are under 23,250 in England, then they qualify for something called a 12-week property disregard, which really is just that the property sits there invisible for 12 weeks. And the local authority therefore have to fund that person for 12 weeks as if they were their long-term responsibility. So it will be limited funding that the individual still has to contribute their pension, etc. And the care home might very well still be asking for a top-up during that 12-week period. And this is the one and only time that the individual themselves, the self-funder, can pay their own top-up out of that remaining £20,000, for example, because they are a self-funder, they're just getting some temporary support. So of course they can choose which care home they want to go to, and of course the care home can charge a top-up during that time. That 12-week money does not have to be repaid. It's designed to give somebody time to think, the family time to think, do we want or need to sell it? Going back to my earlier point, that does a property have to be sold? Actually, no. So if during this 12-week period there were some property valuations, but the property was also valued for rental, and if it was in a condition to rent and the family wanted to adopt the sort of landlord-landlady position, then absolutely you don't have to sell. Now, most people at this point might be thinking, yes, but Nikki, that's all very well, but the rent plus the attendance allowance plus the pensions, even doing the maths in my head, I know that still won't meet the care costs, and there's no other savings, there's no money left. So we'd have to, wouldn't we? Well, You could instead, what you couldn't do is go and get an equity release mortgage on the property because they're only available to owner occupiers. But the local authorities do have to offer a type of equity release. They call it a deferred payment agreement, deferred loan. And what, in essence, they're doing is putting a charge against the property and allowing you as attorneys to borrow whatever is needed to meet the care costs and pay that back at some point. Now, it could be during your loved one's lifetime, but it has to be paid back upon their death. So it's not going to keep the property in the family forever unless you can raise the money to pay that loan back elsewhere, but it would potentially delay the property being sold during your loved one's lifetime, which may be important to you. So there is interest charged, but less than 2%, setting up fees more than reasonable. You still have to meet the care eligibility criteria. So in that example of my aunt, if she were a property owner going into care and wanted to borrow, they wouldn't probably lend to her because they don't think she needs to be going into care. You've got to have the assets under 23, but if you started off with assets of 30,000, spent the money and then wanted to apply for this, that's fine. And the distinction here between the 12-week disregard is that you can borrow the full fee during that 12-week period. It's just the local authority rate that's being paid. 12-week money not paid back, this money paid back. So this follows on from the 12-week disregard. You should always get that first. So, that again, there's a lot more to it. We've got to think about income tax on the rent and what's the capital gains tax position, lots to think about. But I know so many families don't even get told about this. They just literally, care home placement, the next call is to the estate agent, and that doesn't always have to be the way. So just be mindful of that. So now looking really in closing as we move towards the end, the self-funders as a broader category, this could be people that are about to sell a property, have already sold a property, have got investments, self-funder, anyone really that's got the assets, they share with us normally two main concerns every time. If they're choosing a care home, how do I know which one to choose? How do I know which one we can afford? Because we don't have a crystal ball and we don't know how long our loved one will be in the care home. That makes it really difficult to budget, cash flow forecast. And their other concern, quite rightly, is, well, what would happen if the money ran out? That carries uncertainty and it worries us. So they're the two concerns. Now, we can't, with the best will in the world, construct a solution that meets both those concerns and takes them away every time, but we will do our best to try and give some reassurance. And where it is appropriate, we're going to introduce a solution that 85% of families of self-funders have never ever heard of. And just on experience, there will, without doubt, be the majority of the people on this webinar that will have not heard of it or will have heard it vaguely and not really know the detail. I don't want you to think for a minute that I'm saying it works for everybody. I know it doesn't. There are people that come to us that have heard of it, want to get advice on it that we know it won't work for. So we tell them that straight away. There are other people that like the sound of it, but when they actually get further down the process, change their mind. It doesn't look at how they thought it would. So I'm only telling you about it so that you can make informed decisions. Okay, what you do with the information is up to you. What on earth is she waffling on about? Well, let me tell you, it's a solution, a financial product that I mentioned right at the beginning. We can advise on if people want us to. It's a way of capping care costs personally rather than relying and waiting for the government to do it. And it is fundamentally a form of insurance. You can actually insure care home fees at the point or even after moving into a care home. Ironically, you can't insure care home fees in advance anymore. So it's all weird, isn't it? Because our understanding of insurance is that you have to do it ahead of time. You can't insure the car after you've crashed it. You can't insure the house after the ceilings collapsed because the bath leaked. But you can insure care home fees after mum or dad's moved into a care home. Really? Yeah. The technical name for it, I say insurance because I think people understand that concept. The technical Google search engine term is care fees annuity. That would be what you would look up. And the word annuity tends to make people go a bit chivalry, because in the old days, prior to pension freedoms, what happened was people worked all their life, saved into a pension fund, big pot of money, swapped it for an annuity, a pension annuity, and didn't get very much back for their lump sum. But that's because they were retiring at 60, 65. The insurer might be expected to pay out for 30 years or more, might be expected to pay a widow half of the money, might be expected to put the money up every year. So what looks like a big pot, a lot was being asked of it. So annuity rates were deemed poor value. Everybody talks about annuity rates being really rubbish. You don't have to buy a pension annuity anymore. But the concept of swapping a lump sum, paying for a lump sum up front and getting a guaranteed tax-free income for life, however long or short that might be, might that work, the concept, in a care home funding scenario where here are the fees, we've got some income, but we've got a gap and we need to fill that gap with income and we need it for life? It might work as a concept. So it's been adopted by a limited number of insurance companies. So we are the broker, we're the go-between. We go to any insurance company that offers this contract and we get quotes for you. That's our job, completely independent, completely whole of market. And what we do is get permission from you, probably as attorneys, for the insurance companies to contact your loved one's doctor and the care provider, get reports from both, look at that information, look at their data of other people with similar conditions of a similar age, and crudely speaking, they will come to a kind of life expectancy guess estimate, and they will offer terms based on how long they think they'll be paying out for. And they could be right, they could be wrong. You know, that's the gamble, if you like. So if they said, we think this person will be in care for 3 years and that person wants or needs 50,000 a year, then they're going to offer terms at 150,000. If the person only lives for 2 years in care, there's no money returned in that scenario, so they've paid, the family's paid 50,000 out of the estate more than they would have done otherwise. But they've had that peace of mind, and we talk to families all the time that say, I just want the peace of mind, it doesn't matter if we lose money. Conversely, you've paid that 150,000 for a 50,000 income and the person lives in care for 5 years, the insurer has had to pay out 250, even though you only gave them the 150. So nobody knows at outset which way it will work, who will win, and it's around risk, isn't it? Do you want the risk of pay as you go, however you structure that, whether that's investments, under the bed, national savings, who knows, but it's all pay as you go, take the money year by year and hope it lasts. That does carry some element of risk. Or pass the risk to an insurance company, knowing again that you could lose out if the person died early. Now, there are ways to work around that. You can pay extra for a bit of extra capital protection, and you can even buy these on a sort of staggered start date basis, and that all means that you lose less if something happens to somebody early on. But our job is to advise you on all of these options, get the costs for all of these options, and present it in a report for you to have a think about it. So the plans are fully portable. If somebody bought one for one care home, moved to another, they take it with them. They can make provision for fees going up, but you don't have to. It will cost more, of course, to index link the income or put a fixed percentage on, but you don't have to, because if there's money left over, why not just dip into that for the fee increases if it's all about balancing the risk? We'll give you the choice. So I mentioned those capital protection and deferred options. There's also a COVID cover on 3 of the company's policies at the moment. That means any COVID related death for 12 months after the plan is purchased, there's 100% refund. I know that's less of a concern now, hopefully with the vaccine programme, but it's good to know it's there. It's also good to know these schemes are properly protected. So if you bought one from an insurance company that then went bust after you'd bought it, the plans are covered by the Financial Services Compensation Scheme. That's the one that covers your money at the bank, but at the bank you're limited to an 85,000 protection. With these, it's 100% of the income for the lifetime of the person that is protected. So the people that buy these tend to be people that want to ring fence the remaining assets. They think, well, it's mum's money, I'd rather pay a one-off lump sum and know that this reduced amount is at least protected, or they're doing it to avoid that scenario of getting down to 23,000 and asking the state to take over, potentially having to pay top-ups to the care home at that point. So the other question we do sometimes get asked is that if we qualify for that NHS funding that I talked about earlier, after one of these has been purchased, how does that work? Well, the person doesn't need the income per se anymore. They still get it. It's paid into their bank account with a small tax charge deducted. And as I said right at the beginning, we make no charge for researching this option for you. We would be paid a fee if a purchase is made. You know, we have a fairly slick, streamlined process. As I said, we're not coming out and having meetings, and we send you the form by email. You fill it in, send it back. It all goes quiet. The insurance companies do the research. They get the reports, they pay for the reports. Their underwriters are doing all the work to produce the quotes. It's just the point at which we get the quotes back that we will share our expertise and specialism with you in our advice report. But you can do what you like with that report, and we will only be paid if you do make a purchase. But we do know that, I think, when we get to this point of issuing reports, around about 40% of families take the option, 60% don't, but the 60% that don't are still very glad that they kind of went through the options and made an informed decision. The insurance companies that offer these plans, these are the ones that are available in the open market. For the last year and a half, this fourth company has been available only through ourselves. They came to us to pilot the product. As of 2 days ago, they've started to open agencies up with other firms, but my understanding was that's going to be on a fairly slow, reactive basis, so not all firms will have access. Really important to get all 4 quotes because the price difference can be significant. Okay, we never know which one of the 4 will come in the cheapest. So just in closing, we've got this page on our website that if you think, well, you know, I'm not too sure, I've got no idea what that would cost. We've built a really simple calculator. So care fees annuity page on the Elder Care Group website, you put in the age of the person. If they're under 80, it doesn't work. Doesn't mean that you can't have it for an 80-year-old or under. It's just the data isn't secure enough for us to feel confident in giving you a quote online, but we can give you a verbal indication. But certainly for anybody over the age of 80, if you know how much income they might need from such a plan, you pop that into the calculator and it will give you a ballpark. It is an estimate, but it's based on all the quotes that we've collected for somebody of the same age over the years. Now, obviously, your loved one may be more poorly than our average, less poorly than our average. So, of course, there's going to be some flux. But in terms of just giving you that, I haven't got a clue what ballpark we're talking about. This will help. And some people just like to have a little root around and do their own thing before they speak to us. But if you'd rather just come direct to us to discuss it and say, is this something worth looking at or not? Advice at Elder Care Group, drop us a line with an outline of the scenario. That's the easiest and quickest way to get a response, or give us a call. So it's not for everybody. I'm sure you can see that for yourselves. There'll be people watching that will think, yeah, that could work for me, or might not. But it was so important that we flag it up to you. As I say, from my own experience of advising for nearly 20 years, the number of families that simply think they have to sell the property, run the money down, keep their fingers crossed, and have no idea that this is an alternative. So hopefully that's been helpful to you. And as I say, it's such a lot to cover in half an hour. I'm sure I've missed bits, but do come back to us with specific questions if you need to. And